welcome to Fun with Fitzy. We are still on review of grade 11. This is going to go for a couple of videos. Just want to make sure everyone's up to speed when we go into the grade 12 material. Today we're going to be talking about types of ownership and the building blocks of accounting. This is still chapter 1 and this is our second video. There is a worksheet to go with this video, so you can pick it up on the internet and fill it in as you go along. Business enterprises. As you know, different companies are owned differently. A business owned by one person is generally a sole proprietorship. That means one owner. And there's an owner's equity account to go with that. A business owned by two or more people associated as partners is called a partnership. And with this type of account, they do not have an owner's equity account, but they have partner's equity. Each partner has an equity or a capital account, and they each have a drawings account. And you can have several different partners in this type of company. And a business that is organized as a separate legal entity under corporation law and having ownership divided into transferable shares is called a corporation. And corporations have a shareholders equity section on their balance sheet. And there's two sections, contributed capital and retained earnings. And we'll be talking about that later when we get into chapters 14 and 15 in this course. Okay, the basic accounting equation, as you know, right off the bat from grade 11 is assets equals liabilities plus owner's equity. In our textbook that we will be using and getting some problems from, they always use the company's Second Cup as their example. And on Second Cup's annual report, which we'll be talking about more in this course as well, annual reports, they have $18.6 million in assets and $16.9 million in liabilities. And therefore, if you subtract your liabilities from your assets, you will have $1.7 million in owner's equity. Remember, this basic accounting equation must always remain in balance in order for you to have a balanced financial statements. Let's start off with assets. As a reminder, assets are resources owned by a business. Okay, assets are things of value that you own. Okay, things of value used in carrying out activities as production and exchange, as an example. Liabilities, on the other hand, are claims against the assets. You may recall from grade 11 that we talked about two different claims against the assets, and liabilities being the first claim. That means if you were to go out of business and start selling off your assets, the creditors would have first claim. Remember, creditors are people you owe money to, and they are liabilities. Liabilities are existing debts and obligations. Owner's equity, okay, we talked about this briefly, is equal to assets minus liabilities. It represents the owner's claim on the asset. So again, if you were to go out of business and you pay off all your creditors, what's left then belongs to the owners. And within the owner's equity section, we have 4 different types of accounts that we didn't really actually start using in grade 11 until a little bit into the course. But capital, when the owner invests assets into the company. Drawings is when the owner withdraws assets from the company. Revenues are when you make money. And expenses are things that you have to pay in order to stay in business. And we're going to talk about these each one step by step. Investments, like we just said, by the owner, are assets put into the business by the owner. Usually it's money, and we call that capital. These investments in the business increase owner's equity. Drawings, on the other hand, are when the owner takes assets out of the company for their personal use. Usually it's cash, but sometimes they take out other assets, vehicles or computers. And drawings decrease owner's equity. Revenues are the gross increases in owner's equity resulting from business activities entered into for the purpose of earning income. Revenues may result from the sale of merchandise, performance of services, rental of property, or lending of money, and many other different examples. Revenue usually results in an increase in an asset, either in accounts receivable or cash, because when you provide a service, let's say you cut someone's hair, they either owe you the money or they give you the cash right off the bat. Expenses, on the other hand, decrease owner's equity that result from operating the business. Expenses are the costs of assets consumed or services used in the process of earning revenue. So an example of an asset consumed that I can think of would be supplies, and services used would be your phone, heat, hydro, stuff like that. And here are some examples: utility expense, rent expense, and supplies expense. This slide here talks about the increases and decreases in owner's equity. So everything here on the left-hand side increase owner's equity. So investments by owner increase owner's equity and revenues increase. Whereas these things, when the owner withdraws, this is drawings, remember, decreases owner's equity, and expenses decrease owner's equity. So that's the end of this video. By now, you should be able to know the fundamental accounting equation. Assets equals liabilities plus owner's equity. Know different types of accounts, so assets, liabilities, and owner's equity, and the 4 different types of owner's equity accounts: revenue, capital, drawings, and expenses. And understand what types of transactions affect equity. Thanks for watching, and I hope that helped, and have a great day.